Hey, are you struggling trying to figure out the right tax status for your limited liability company? Well, in this video, I'm going to be breaking it down for you, showing you the difference between disregarded entity, partnership, S corporation, or C corporation, and when it makes the most sense for your limited liability company. All right, let's get started. Okay, so when it comes to making a tax election for your limited liability company, it is really going to depend on what your LLC is doing. That means what type of activities do you intend or are you currently running through that company, because that is going to have a major bearing on the tax election you're going to select for that company. Now, let me just break this down for you to give you some sense of what I'm referring to. So when you set up an LLC, you can choose with the IRS how you want them to treat it for federal tax purposes. You can elect to treat that entity as a disregarded entity. Now, what does that mean? It means it will not file a tax return, that any income or expenses and losses and all that stuff, it just gets reported on the individual's member's return. Now, the thing about a disregarded tax status, if you want to make that election, here's something you have to know. You can only have one owner in your limited liability company. So there can be only one owner, or since it's an LLC, one member. Now, another status you have is what is referred to as partnership. Okay, and that's pretty simple, right? This is a flow-through structure. That means anything that's generated inside of the partnership or inside of the limited liability company will flow down and be taxed to the members of the LLC. Now, in order to make a partnership tax election, you have to have two owners, or again, members of that limited liability company. So two or more in order to elect a partnership. Now, in order to be a partnership, you could be you and it could be another business entity. It's not uncommon for us to create limited liability companies. So we set up an LLC here and it's for a single individual and they want to have partnership tax status, as I'm about to explain to you when you should use it. And they don't have someone else in their life that they're comfortable putting on their LLC. Well, in that case, if they have another business entity over here, maybe they have a corporation that they've set up, this can then become their other partner in their LLC. So when you're making or the election to treat your company as a partnership and you're wondering, where is that other owner? If you have another entity set up, that entity could possibly be the owner of your LLC. All right, so the next election you have is what is referred to as S corporation. Okay, S corporation, minimum of one owner, up to, 75 is the max, but we're not going to go there. But let's say at least one owner. So you have to have one owner here in order to make an S election for your limited liability company. Now, like a partnership, this is a flow-through entity. So it means any income generated inside of the S corporation, after expenses, that income will flow through and hit the members based upon their ownership percentages. And then the last one is C corporation tax status. Again, minimum of one owner. And with the C corporation, well, it's pretty simple. The C corporation pays its own tax on its income, and everything is taxed at a flat 21%. Okay, so here are the four tax statuses that we're going to be working with and breaking this down for you so you can get a better understanding of when you should choose one of or make one of these tax elections for your limited liability company. Let's go to a new screen. Okay, so let's start with disregarded. So as I stated, the disregarded LLC is misspelled that. A disregarded LLC is one that does not have to file a tax return. So it just passes right through you. It's completely ignored by the IRS. So when might you elect to treat your company as a disregarded LLC? Well, a lot of times we use disregarded tax status, one, for real estate LLCs. Okay. Now, what do I mean by real estate LLCs? If you want to set up a limited liability company here, and I'm going to put a property into it, and many times you'll notice from my other videos, I like to have these real estate LLCs held by a holding company here in Wyoming. All right, so they have it held by a holding company. Well, as you acquire properties and you're creating more real estate LLCs for your investments, the last thing you want to do is file multiple tax returns for each of those companies. So this is a prime example of when you would choose disregarded tax status. You would elect to treat this LLC and this LLC, all the LLCs that are going to be owned by your holding company, as disregarded LLCs. So it minimizes the number of tax returns you're required to file. So it lowers your operating costs. So that is a common one where we're using real estate. Another example of when we might set up a disregarded LLC is for safe assets. Okay, so what do I mean by that? Safe assets would be stocks, bonds, brokerage accounts, metals, okay, investments like stamps, things like of that nature, savings, assets that you're going to hold long term, that you do not run as a business. You're set up to collect, passive income. That's where you may elect to treat your LLC as a disregarded entity. So a good example of that would be a scenario where I've created a Wyoming holding company right here, Wyoming LLC, and into this LLC I put my brokerage account, I put my savings account inside of there. Maybe I have some stamp collection, so I have collectibles that go inside of there. Maybe I'm issuing out private lending, so I'm loaning people money. That would be inside of this limited liability company. So this LLC, there's no real tax play here that I'm looking for. All I'm concerned about is asset protection. So again, I'm going to make a disregarded election on this LLC so everything flows down to me and I don't have to file a separate tax return, because there's really no benefit for filing a return for these types of investments. So another way to look at this would be passive activities. Okay, is when I would use disregarded tax status. Now, partnership. Partnership is, you're typically going to elect partnership tax status for situations where you're going into business with someone else. If you're going to do a JV, a joint venture on passive activities. So what is a joint venture on passive activities? Well, that is one in which, say, you're going to buy a piece of property and you're going to hold it long term. It's you and a friend. You're going in on this deal. That's a passive activity because it's a rental property. So it will be set up as a partnership because you have two or more members. And again, as I stated, the partnerships, they file a tax return. They actually file a 1065. And then the partnership that you've created for you and your partner here, all right, let's say we set this this partnership up where it was 60-40. Then if you make $1,000 in profit, $600 is going to be allocated to this partner. $400 for tax purposes would be allocated to partner number two. Again, that would be reflected on the 1065 return, and each partner receives what is referred to as a K1. So we use this tax status, partnership tax status, for joint ventures in real estate. Another instance in when you may choose a partnership tax status is if it's your real estate holding company. Now, I showed you the example of using the disregarded LLCs. So let me just call this real estate holding LLC. All right. So what does that look like? You have your specific property LLCs right here that are both disregarded. Those red boxes don't have to file tax returns, but this blue box will file a tax return. This will be set up as a partnership for federal tax purposes. Now, why would I want to do that? Well, there are situations from a real estate standpoint where you do not want these assets here, this real estate, flowing down onto your 1040 and showing up on your Schedule E, page 1. So we use a partnership to create a K1 on this income, which means it still flows to my 1040, but the income shows up on a different line on your 1040. Now, this is something that a lot of real estate investors are not aware of, that how your tax return looks can have an impact on your ability to borrow. So one of the things we focus on here at Anderson when we're working with clients is we're setting up their structures and we're thinking about their business, right? Do you intend to go out there and work with lenders? If so, then I want to change how that income hits your return, because I can set up an entity where that income is going to hit your return and it's going to make you look stronger to a potential lender. And that's how you can use a partnership. Or if you want to reduce your risk of audit, and that's another situation when you're holding passive investments. We'll use a partnership for that holding company status. So partnerships are great, again, for passive activities. If it's just you and a spouse, let's say, in your holding company, or it's you and a business partner, then you're going to elect partnership taxation. Now, when we go to the active business side, so this right here, everything I've been discussing, these two right here, think of it this way. This is all passive. Okay, passive activities, not active, not running an actual business. To run an actual business, if you're going to go active, then you're going to look at using an S-corporation for federal tax purposes. Now, with an S-corp, you're going to file an 1120S tax return. Now, what types of activities are we going to then utilize for the S-corporation? Well, as I stated, an active business. And so here's where you're going to have those types of activities. Maybe you're an Uber driver, you've got a little side gig going on, you're bringing in $70,000, $80,000 a year. S corporation is going to make a lot of sense for you for those types of active businesses. The thing about the S corporation that's so attractive for an active business, unlike the other two that I just showed you, is that when you work in the business itself, that income that flows down to you, you're able to control it, meaning you can treat part of it as salary, which means you have to file a W-2, and you can treat the other part as a distribution, which is not subject to self-employment taxes. And that's really the crux of using the S corporation, that is to reduce your self-employment taxes on the active income. If I had elected disregarded tax status or partnership tax status for an active business, I cannot escape that 15.4% employment tax on all of my income. Whereas with an S-Corp, you can, because if you were generating $80,000, you could look at that and say, well, a reasonable salary for me might be $35,000. That will be subject to the 15.4%, and I will take the other $45,000 as a distribution and not have to pay that additional tax. That's why people make this election. So an S-Corporation, again, active businesses. If you flip real estate, if you're wholesaling real estate, that would fit into this category of S-Corporation tax status. Now, the C-Corp, when do we use that for our businesses? Well, with the C-Corporation, typically what we're looking at is if you're making a lot of money, all right, what do I mean by a lot of money? $800,000 or more in income, you may want to look at a C-Corporation. So this would be available for high income earners, would be one, because if you don't need all that money right now, why use an S-Corp where it's all going to flow out to you and be taxed at your individual tax rate, which could be as high as 37%. With a C-Corp, as I stated, it's taxed at a flat 21%. So whatever I'm not taking out, if I leave $400,000 in my C corporation, that I'm only going to pay tax at 21% on that $400,000 versus 37% if it was an S corp and it flowed out to me. I can then always use that money to reinvest or loan it out to myself. And now I'm saving on taxes by having that lower tax bracket. That means I have more money left for those two different strategies I just shared with you. So what does that mean here? If you plan to reinvest into your business, then I would look at using a C corporation. Number three, if you do not want the activity on your return. Okay, so if I don't want the business activity on my 1040, then I'm going to elect a C corporation tax status. And here's where this can be beneficial to you. If you've got a business that's losing money, okay, now you might be wondering, why am I in business if I'm losing money? It just happens. You're putting more money back into it and you have a lot of expenses right now because it's a startup. Then you may want to elect C corporation tax status for your business because you do not want those losses flowing down to your 1040. Why is this important? Because if those losses hit your 1040 and you're trying to obtain loans, let's say it's to buy real estate, grow other businesses, then the lender or the underwriter will see this on your 1040 personal income tax return and they'll know you have a business that's struggling, or they'll assume that it's struggling, and that will impair your ability to borrow. This is the number one mistake that I see with real estate investors who are also business owners that are starting up a side gig and they're not making a lot of money in their side gig or losing money. That is disclosed on their 1040 if it's an S-Corp or partnership or disregarded entity, and it does create problems for them in financing the other portion of their investing. So if you fall into that category, then choosing C corporation tax status is probably going to be something you ought to consider. And again, this C corporation, it is for active business activities. Just like the S corporation, this is all of our active stuff right here. So that's what you want to be focused on. If you're in passive, look at partnership or disregarded. If you're active, be looking at an S Corp or C corporation tax status for your limited liability company. And the last thing I'd leave you with here as far as choosing your tax status, it's really simple to set this up. All you need to do is go to the IRS. You just search EIN IRS, go to the government's webpage, and you can complete all the information right now and receive your number immediately. Hey, if you got something out of this video, you liked the video, be sure to hit the like button. And if you're not yet a subscriber, well, now's your opportunity. Take care.